Over the past 11 days, our military has virtually destroyed Iran.
For the first time in history, Iranian officials say the country has closed the Strait of Hormuz following joint strikes from the U.S. and Israel. While this is not an officially recognized closure, shipping has been completely stalled in the strait.
A shortage of aluminium is impacting the supply of a wide range of goods in the US. Experts say it means average Americans are having to pay much more for the basics.
We got to finish the job, right? That opening line sets the tone for a story that at first sounds like a show of strength, but quickly turns into a complex economic shift that few people fully saw coming. Before any tariffs were introduced, the aluminum relationship between the United States and Canada was not just another example of international trade. It functioned almost like a single, seamless industrial system. Canadian producers, especially in regions powered by hydroelectric energy, were able to produce aluminum at lower costs and with a smaller carbon footprint compared to many other countries. At the same time, American manufacturers relied heavily on that steady flow of aluminum to keep their own industries running efficiently. From automotive plants in the Midwest to construction companies and packaging manufacturers, aluminum coming from Canada was deeply embedded in the U.S. supply chain. The process was smooth and predictable. Raw materials moved quickly across the border through established rail lines and trucking routes. Factories operated with synchronized timing, and long-term contracts ensured stability for both sides. It was the kind of system that, over time, became so efficient that people stopped questioning it altogether, assuming it would continue indefinitely without disruption. However, that assumption began to break the moment tariffs entered the picture. What seemed like a straightforward policy decision, imposing a 25% tariff that later increased to 50%, had far-reaching consequences that went beyond simple price adjustments. In theory, the idea behind such tariffs was to make imported aluminum more expensive so that domestic production within the United States could become more competitive. But in practice, the immediate effect was very different. Instead of gradually shifting demand toward American producers, the tariffs acted like a sudden barrier that disrupted the natural flow of trade. Canadian aluminum, which had once been the most convenient and cost-effective option for U.S. buyers, suddenly became significantly more expensive. This did not lead to a slow adjustment period. It triggered a rapid change in behavior. Canadian producers, facing a market that had become less economically viable almost overnight, began to look elsewhere. And in global trade, suppliers rarely wait for conditions to improve. They move quickly to secure alternative markets. That is exactly what happened as Canadian aluminum exports started to shift toward regions that were not only willing to buy but actively seeking the kind of product Canada could provide. Europe emerged as a key destination during this transition, driven by a different set of priorities. Unlike the United States, where cost competitiveness was the primary concern, European markets were increasingly focused on sustainability and reducing carbon emissions across their industrial supply chains. Canadian aluminum, produced using clean hydroelectric power, suddenly became highly attractive in this context. What had once been just a background advantage, lower emissions turned into a major selling point. European manufacturers, particularly in industries like automotive and aerospace, began incorporating Canadian aluminum into their long-term sourcing strategies, not just because it was available, but because it aligned with regulatory pressures and environmental goals. This shift did not happen through dramatic announcements or headline-making deals. It unfolded quietly through contracts, negotiations, and logistical adjustments that gradually redirected the flow of aluminum away from North America. Within a relatively short period, the numbers began to reflect this transformation. The United States, which had previously dominated as the primary destination for Canadian aluminum exports, saw its share decline, while Europe's share increased significantly from almost negligible levels to a meaningful portion of total exports. This kind of rapid rebalancing is not typical in global trade, where changes often take years to materialize. Instead, it signaled something deeper, a structural shift rather than a temporary fluctuation. Once supply chains are reconfigured and long-term agreements are established, they create a new baseline that is not easily reversed. Manufacturers build their production processes around reliability and predictability, and once they commit to new suppliers, they are unlikely to switch back unless there is a clear and lasting advantage. Meanwhile, within the United States, the expected benefits of the tariffs did not materialize in the way policymakers had anticipated. Aluminum production is fundamentally tied to energy costs, and this is where the economic reality becomes impossible to ignore. Producing aluminum requires enormous amounts of electricity, and countries with access to low-cost energy, particularly hydroelectric power, have a natural advantage. Canada, along with nations like Norway and Iceland, falls into this category. The United States, on the other hand, generally faces higher industrial electricity costs, which makes large-scale aluminum production less competitive. This means that even with tariffs in place, domestic producers could not easily expand production to fill the gap left by reduced imports. The challenge was not just financial, it was rooted in the physical and infrastructural limitations of the industry. Building new smelters or restarting inactive ones requires significant investment, stable energy supply, and long timelines that extend far beyond the immediate impact of a policy change. As a result, instead of seeing a surge in domestic output, the United States experienced a tightening of supply combined with rising costs. This gap between policy intention and actual outcome highlights a key aspect of global trade. It is shaped not only by regulations and decisions, but also by underlying economic and physical constraints that cannot be easily altered. What makes this situation particularly significant is how quickly a long-standing and deeply integrated system began to unravel once those constraints were disrupted. The aluminum trade between the United States and Canada had been built over decades, supported by geography, infrastructure, and mutual dependence. Yet within a short span of time, that system started to shift in a new direction, driven by market forces responding to changing incentives. Canadian producers diversified their customer base, reducing their reliance on a single market, while U.S. manufacturers were left navigating a more complex and less predictable supply environment. This marks the end of what was once considered a stable industrial relationship and the beginning of a new phase in global trade, where supply chains are being reshaped not just by policy decisions, but by the broader dynamics of energy, sustainability, and economic efficiency. As Canadian aluminum supply continued shifting toward Europe and other global markets, the United States increasingly relied on more distant suppliers, especially in the Middle East. While this helped replace lost volume on paper, it introduced serious risks tied to long and complex shipping routes. Key trade choke points like the Strait of Hormuz became critical links in the supply chain, making the entire system far more vulnerable to geopolitical tensions and regional instability. When disruptions began affecting these routes, shipments slowed, delays increased, and what once seemed like a manageable adjustment quickly turned into a growing supply concern. At the same time, domestic aluminum production in the United States could not scale up fast enough to offset these challenges. High energy costs and the long timelines required to restart or build smelting facilities made rapid expansion nearly impossible. This created a tightening supply environment where industries that depend heavily on aluminum, including automotive, construction, packaging, and defense, began facing rising input costs and operational pressure. What had once been a stable, efficient, and predictable supply system evolved into a fragile network with limited flexibility. As pressure continues to build, policymakers are left with a difficult decision: adjust tariffs to restore faster and more reliable supply from nearby sources, or maintain current policies and risk prolonged strain across key sectors of the economy.